Hey, what's going on, guys? Tim Bratz. Hey, I just got a message about somebody who wanted to become a private investor. They were asking, hey, how do you pay your private lenders? How do you structure deals? What does that look like? And so I want to give you a little bit of a high-level background on kind of what a traditional syndication looks like, what a straight debt loan looks like, and then what maybe a hybrid in between those two things could look like. The easiest way to look at private lending in the first capacity is as a debt, right? If you lend somebody $100,000 and they're going to go and flip a house or use it for some sort of business purposes, and they say, I'm going to pay you 12% per year on your money, it's a fixed, predictable amount of return on your investment where I would give them $100,000, they're going to pay me back $12,000 per year on that money pro rata. If they borrow the money for 6 months, then they would pay me back essentially 1% per month, which is 6%, but the money was only out there for 6 months. So if you annualize it, it'd be a 12% return, right? That's a very simple debt type of a loan. On the opposite side of the spectrum are equity investments. So if you go and contact a syndicator, someone who raises capital either for a business or for a piece of real estate, a lot of times you'll invest as an equity investor in those deals. And as an equity investor, if you took $100,000 to that deal, let's assume it's a stabilized deal and it's cash flowing and it's occupied and there's renters in place, you would get a piece of the equity ownership in the LLC that owns that deal. Meaning if I own a building at 123 Main Street, every building I own is in a separate LLC for asset protection purposes and from a standpoint of easy to manage, there's no commingling of funds or anything along those lines. And every different building that I own has a different partnership structure. I might have a different percentage in each one of them. I might have joint venture partners in some and not in others. I might have different types of investors in different projects. So that means each property needs its own entity. So it's going to have its own LLC, and in that LLC operating agreement, it'll dictate who owns what percentage. So if you invest $100,000 into that deal, you might get a fraction of a percentage, you might get a larger percentage of that deal depending on the size of the deal and what the terms are. For simplicity, let's say you own 1% of the deal for bringing $100,000. Might not seem like a lot, but what if that cash flow kicks off, $8,000 a year to you in positive cash flow? And there's probably some equity upside, downside risk that comes with it. If there's no cash flow, then maybe there is no, but maybe there's equity upside. Maybe it's a flip type of a property where you have a big win or a big windfall on the back end whenever you sell or you refinance. So you have upside and downside, but you don't have the predictability as you do over here as a debt. You have the predictability in the cash flow, but there's no upside or downside. If you lend somebody $100,000 and they make $1 million on it, you don't get any portion of that. You get your predictable income. If they lose all their money, you get your money back and you get your predictable income, right? So it doesn't really matter upside, downside. Over here, you have predictability to it. Over here, you have all upside, all downside. You could lose your $100,000 without any sort of recourse against getting that money back, but it could be big, big upside, but you don't get the predictability. What I've found is there's different types of mindsets and different personalities for different investors and strategies and goals and where they are in their life, and how much time horizon they have to take riskier type of investments with bigger upside or more stable investments where they want just predictable cash flow. And I've found there's a lot of people who want both. So why not offer some sort of a hybrid that has sort of that debt structure along with an equity structure combined? And so that's how we structure a lot of our deals. And a lot of people in Legacy Family, my mastermind, and I've seen it pop up a lot more since I started educating on this. But I think it bridges the gap between both of those mindsets. So what we do is we pay a predictable rate of return, typically in that 8% range, regardless of the property's performance. So if a property's not performing, meaning it's a new construction project or it's a heavy value add where I have to reposition the entire deal, we will build it in sort of like an interest reserve. So the same way that the bank is going to give you a loan on a new construction project and you're like, hey, it's not cash flowing, how do I make the payments? They create an interest reserve that they pull from for their payments for a certain amount of time. We do the same thing for our investors. It's just a cost of the deal, right? It's a carrying cost of the project. You got, here's what the land cost is, here's what the building cost is, here's what the carrying cost is, and that's a part of the carrying cost. So we build that into the project and make sure that when we underwrite the deal, we're still at a low enough basis where we feel good with that carrying cost to be able to move on the deal at that price point. If it's a new construction project, we might know that we need 18 to 24 months of runway in order to borrow that additional money in order to cover the carrying costs. If it's a reposition on a renovation of an apartment complex, we might only need 6 to 12 months, right? So it's a little bit, it's pretty predictable how much money we're going to need because we know how long it takes us in order to reposition one of these projects. So the first way that our investors get paid is from that preferred rate of return, that predictable cash flow on their money. Then we give them a piece of the equity in the deal in perpetuity. It might not be as much equity as in a traditional syndication. Traditional syndication, the equity investors could own somewhere between 50 to 80% ownership in the deal. And the equity investors are the passive investors, the limited partners, the private money who's putting that investment up. They might own a big chunk of the deal, but again, they have all the risk and there's no predictable cash flow. And a lot of times that operating partner who owns the other 30 to 50% of the deal or 20 to 50% of the deal typically gets a bunch of fees off the table. I don't love that structure because you're not in the same boat rowing in the same direction with the investors. The operating partner's taking a bunch of money off the table in fees, and it doesn't matter if the property performs or not. All right, the investors only get paid if the property's performing. So I don't love that unless it's a very big and already stabilized deal, right? If you brought me a $200 million skyscraper and you said, hey, this one equity group is going to just write a single check, and hey, Tim, you got 15% ownership in this thing, but you get a 2% acquisition fee and a 1% ongoing asset management fee, and we're going to hold on to this thing for the next 10 years. I would probably do that deal, right? That's $4 million that I would get up front, 15% equity in this massive building, and ongoing asset management fees for something that's already stabilized, has management in place, doesn't need any project management or any Herculean effort on the asset management part. Yeah, I would do that deal, and I think that makes sense there. But if you're an active operator, or if you're looking to invest with somebody who does new construction, or you're looking to work with somebody who does repositioning of assets, you got to realize that there's a lot of heavy lifting and a lot of work that comes into that value creation that they're doing. And so I think there's this kind of middle ground of, hey, we typically give 20 to 40% ownership to our investors on top of the predictable cash flow, and we don't nickel and dime on a bunch of different fees. We might take an acquisition fee, but we don't take capital events fees or fundraising fees or loan sponsorship fees. I think we've only once taken an asset management fee, or we've never taken a disposition fee. So like other operators will nickel and dime the deal to death and take all their money off as fees, whereas people look at just the equity and, oh, I get more equity in this deal, so I'm going to go and invest in that one. That doesn't mean it's a good deal, right? Having a predictable rate of return on your money, along with somebody who's operating similarly to your goals, right? Where I get my big windfall of money is when I refinance and I get the investors paid back, then I get my piece of the cash flows and of the refi proceeds and any sort of sales proceeds. So we've structured it in a way where we're in line with the investors. We can keep the lights on by taking a couple minor acquisition fees maybe, and then the investors get the hybrid of both the debt side of things and the equity side of things all combined into one. So now they're making a predictable 8% on their money. On top of that, any sort of cash flows above and beyond that, which could push it to 9, 10, 11%. They have their percentage of ownership in the deal, which gives them potential refinance proceeds, their percentage of depreciation to offset a lot of those returns that they're making. And whenever we sell the property in the future, they have a piece of equity that will grow over time as we pay down principal and as the property appreciates, where they're going to have another big windfall of cash even after their $100,000 investment is returned to them. So hopefully that gives you a good idea of the different types of ways that you can passively invest in deals, from the debt side to the equity side, and then a hybrid in the middle of what that can look like. Next step is go find a great operator. Find somebody either in your local market or regionally or nationally who has a great reputation, who has been around the block a few times, that isn't going to learn on your time and on your dime. Make sure you have somebody who knows what they're doing, so that way your investment is safe, your investment is secure, you know that you're going to have predictable returns on it, some equity upside, because they can get it done. So if this is helpful for you, please like the video, please put a comment below. Let me know what kind of things that you're investing in currently and how this would stack up against some of the other things that you're investing in. I know that there's other opportunities to make greater returns or lower returns and safer and riskier and all those different kinds of things. I personally have never seen anything that competes with commercial real estate or privately lending into a syndication. Toe-to-toe, I'd put it against anything else out there, because you have the predictability of cash flow, you have the depreciation and the tax advantages that come with it, you got the equity upside, you got the principal pay down, and all the other benefits that come with investing in real estate. But if you have something else out there, I'd love to hear about it. Please send it over to me. I'll put it toe-to-toe. Maybe we can compare some notes and see how each thing adds up. But I appreciate you guys listening. Please please subscribe to the channel. We're always trying to put out more value. If there's something specific that you want to hear about, please put it in the comment section below. I'll create a video specifically answering that question and deliver it to you. So I appreciate you. Until next time, be your best.